If you're studying for the CPA exam, one common challenge is figuring out which types of investment income must be included in gross income and which ones are excluded. In this lesson we're going to focus on interest income, which is one of the most frequently tested topics in the regulation section of the CPA exam. We'll walk through how interest income works, identify common sources such as bank accounts and bonds, and explain the important exception involving municipal bond interest, which is often excluded from federal income tax. Let's get started. In this lesson we will focus on interest income, which is one of the most common forms of investment income tested on the reg section of the CPA exam. First, we will define what interest income is and explain why the tax code generally treats it as taxable income. Next, we will identify several common sources of interest such as bank accounts, bonds, and government securities. Finally, we will discuss the most important exception you must remember for the CPA exam: municipal bond interest. Understanding when interest must be included in gross income and when it can be excluded will help you correctly answer many reg questions involving investment income. Interest income is earned when a taxpayer allows another person or organization to use their money and receives compensation in return. In simple terms, interest is the price paid for borrowing money. For example, when you deposit funds into a savings account, the bank pays interest because it is using your money to support lending activities. Similarly, when investors purchase bonds, they are effectively lending money to the bond issuer and receiving interest payments as compensation. From a tax perspective, the default rule is that interest income must be included in gross income. On the CPA exam you should start with the assumption that interest is taxable unless the question specifically describes a situation where the tax code provides an exclusion. Interest income can arise from several different financial instruments. The most familiar example is interest earned from a savings account or certificate of deposit at a bank. Another common source is interest earned from corporate bonds. When investors purchase a bond issued by a corporation, they are lending money to that company and receive periodic interest payments in return. Interest can also come from U.S. Treasury securities issued by the federal government. Although these investments differ in structure, the key concept for the CPA exam is that most interest from these sources must be included in gross income unless a specific rule says otherwise. Municipal bonds are an important exception to the general rule that interest income is taxable. These bonds are issued by state and local governments to finance public projects such as roads, schools, or infrastructure improvements. To make these bonds attractive to investors, the federal tax code provides a significant tax benefit. In most cases, interest earned from municipal bonds is excluded from federal gross income. For the CPA exam, this rule appears frequently in multiple-choice questions. If a problem clearly states that interest was earned from a municipal bond issued by a state or local government, that interest is typically excluded from federal income tax. Let's look at a simple example similar to what you might encounter on the CPA exam. Suppose a taxpayer earns $800 of interest from a savings account and $700 of interest from corporate bonds during the year. Both of these sources represent taxable interest income. To determine the total interest that must be included in gross income, we simply combine the two amounts. In this example, the taxpayer would report $1,500 of taxable interest income. Questions like this are common on the reg exam and typically test whether you can correctly identify which sources of interest are taxable. Here is a practice scenario similar to a CPA exam question. A taxpayer earns $500 of interest from a savings account and $900 of interest from a municipal bond issued by a state government. The key question is how much of that interest must be included in taxable income. Because savings account interest is taxable, the $500 must be included in gross income. However, municipal bond interest is generally excluded from federal income tax. Therefore, the $900 would not be included in gross income. The correct taxable interest amount would be $500. When solving interest income questions on the CPA exam, a useful strategy is to assume that interest is taxable by default. Once you identify the source of the interest, check whether the problem introduces the municipal bond exception. If the interest is from bonds issued by state or local governments, it is generally excluded from federal income tax. This simple approach allows you to quickly identify the correct treatment without overcomplicating the problem. Interest income represents compensation for allowing another party to use your money. Most forms of interest, including interest from bank accounts and corporate bonds, must be included in gross income. However, the tax code provides an important exception for municipal bond interest. Interest earned from bonds issued by state or local governments is generally excluded from federal income tax. For the CPA exam, remember this simple rule. Assume interest is taxable unless the question clearly identifies municipal bond interest. Capital gains are another major source of income. The basic idea is simple. If a taxpayer sells property for more than its basis, the taxpayer has a gain. On the exam, the core formula is amount realized minus adjusted basis. Students sometimes get overwhelmed by all the capital gain terminology, but for an introductory lesson, keep it simple. First identify the sale. Then compare the sales price, or amount realized, to basis. If the sale price is higher, there is a gain. After that, the holding period determines whether the gain is short-term or long-term. Let's put the concept into a quick example. Suppose a taxpayer earns an $80,000 salary, receives a $10,000 bonus, and earns $1,000 of bank interest during the year. All three items are taxable, so the gross income calculation is straightforward. 80,000 plus 10,000 plus 1,000 gives us $91,000 of gross income. This is the type of simple aggregation the CPA exam loves to test. The exam often mixes several ordinary income items together and asks you to identify the total amount that belongs in gross income. This is one of the most common reg traps. Municipal bond interest is generally excluded from federal gross income. That means it does not increase federal taxable income in the usual way. However, students often make the mistake of thinking that excluded means it never appears anywhere on the return. That is not the right mindset. Some excluded items still matter for reporting or for related calculations. So on exam day, remember the exact rule. Municipal bond interest is generally excluded from federal income tax, but it is not invisible for all purposes. Here's the simple process I want you to use on exam day. Step 1. Identify the economic benefit. Ask yourself whether the taxpayer received cash, property, services, or some other measurable value. Step 2. Check for an exclusion. Look for a rule in the tax code that specifically removes the item from gross income. If you do not find an exclusion, your default answer is that the item belongs in gross income. This process is simple, repeatable, and very effective. It keeps you from overthinking questions and helps you move faster through both multiple choice questions and simulations. Let's wrap up the lesson. Gross income is defined broadly under IRC Section 61, which means most economic benefits will be taxable unless the tax code specifically says otherwise. The common income categories you need to recognize include compensation, interest, dividends, business income, and capital gains. Most importantly, do not approach these questions randomly. Use a consistent process. Identify the economic benefit first. Then check for an exclusion. If no exclusion applies, include the item in gross income. That one method will help you answer a large number of reg questions with more confidence.